to the session. This is the last session of your paper, that is capital investment and financing decision. This unit is devoted to discussion about the investor relations, which is a new function in the corporate finance, which talks about how we are going to maintain the relationship with the various stakeholders of the company. So we'll talk about the how to appropriately maintain relationship. And of course, when we talk about investor relations, the foremost thing here is the disbursement of the various information to the various stakeholders. So we'll be focusing on the disclosures and some of the corporate governance, as well as the uh, as well as other aspects for maintenance of the investor relations. Now, if you look at the why the economy as well as the company, both of them, they require money to grow. So the money will come from the individuals who are saving the money and who will invest the money in the company for the growth. I mean, they will require return on their investment, and the money, when it comes to the company, it will grow. So the point is, when we're talking about an individual who is saving his money, and why would he part with his money to invest his money in your company? Because probably you have to develop that kind of a trust within the individual who is going to put his money into your company. Now, the business units, they require the fund for what is the purpose that a company will require the fund? The company requires the fund for, I mean, acquiring assets, using which it will manufacture certain products or it will invest in good projects, and so that they ultimately achieve the highest profitability through the economies of scale. Now, to do that, the companies require huge amount of funds, and these huge amount of funds are difficult to be arranged from the banking sector, because the banking sector has to cater to the various investors as well as the public and the government. So this huge requirement of the business cannot just be met from the banking sector through the loans. Now, the company form of the organization, sorry, with this when we have a company form of the organization, now the organization now can raise a huge amount of capital from the public, and that is allowed under a company form. Now it is now possible for the company to collect money from millions of investors spread across the globe, and these investors not only provide capital for starting of a business, they also provide the capital for the growth of the farm. Now, the funds that are provided, funds can be availed from the investors in two routes. One is a equity route. So, when you are buying equity, you become equity holders or owners of the company. And the other route is the debenture or the loan capital. So, you become the lenders of the company. So, the investment can come from the public in these two channels. Now, the point is, the when we talk about the corporate form of organization, now the company form of organization, it was earlier, it is in India, it is governed by the Companies Act, and we had a old Companies Act which was in the act was passed in the year 1956. It was time and again amended and revised, and ultimately it was replaced by the new Companies Act of 2013. Now, the Companies Act of most of the countries, it allows a group of people to start a business, and this business can become a company, and they can approach the public to raise capital in the various routes, either in the route of the equity or in the route of the debt. Now, the small investors, they, they can buy shares of the company, and they can become shareholders. The institutional investors will not only buy the shares, they may also lend to the companies against the bond and the mortgages. So we see that what happens is the owners of a company are they could be very small time investors. Maybe even if you have, even let us say 5,000 rupees also, you can become a shareholder or owner of a company. So basically the shareholding will be scattered. It does not mean that the actual control of the company will be in the hands of these scattered shareholders. The shareholders can vote to elect a particular board of director, and these board of director, they are responsible for running the company, so that the control is only limited to that aspect. However, now the investor range will increase with the size of the company. The bigger the company, the company becomes, the number of shareholders will increase and the number of shareholders will be scattered. So the investor base will be increased. But the control will have to be there in a center so that the company can run successfully. So the ownership will be spread across several countries or across the globe, not just one country. Now, we can see that if we look at the NSE Nifty, the 50 index stock, if you look at the Nifty's composition of 50 shares, there is something that is called the full market capitalization. A full market capitalization is basically the market price per share into the number of shares. Now that is something else. Now the Nifty 50 shares, they are selected. There is selection criteria, and one of the criteria is that they should have the top market capitalization. Now, when I'm talking about market capitalization, is not just the total market capitalization that Nifty takes into account. It rather talks about something called a free float market capitalization. This will give us an idea regarding how diverse or how spread the investor base is in companies. Now, if you look at the free float market capitalization, you see the free float market capitalization, it is a proxy measure to determine the diversification of the investor base. Now, what is a free float market capitalization? It is calculated by considering only those shares which are openly traded in the market. That means these are not locked in shares, or these are not held by the promoters, because of course promoters shares do not trade in the market. So these are the shares held by the small time retail investors which are openly trading in the market. So that is called a free float. Now, how do you compute the free float market capitalization? You multiply the free float number of shares into the market price per share, so you get the free float market capitalization. Now, the some of the shares which are excluded from the from the shareholding are the promoters, the founders, and the director share. The shares that are being held by private equity funds or the hedge funds, the locked-in shares, for example, employee stock option shares, which are not traded in the open market, so they are locked-in shares. You can have cross-holding by related companies in a, suppose your company, we were talking about this in corporate restructuring, like a subsidiary company might be holding some of your shares. Those are not traded in the market. The shares held by the various trusts also not actively traded. So you have to exclude these shares while you are computing the free float market capitalization. Now, a company which has a diversified investor base will have higher proportion of free float market capitalization in its total market capitalization. And in fact, Nifty will only pick those companies who have the highest free float market capitalization. And we know if a share, it is a great reputation to be included in the Nifty index. So the companies are also trying to have more of free float market capitalization. Now, how can you have more of free float market capitalization? You have to you need to ensure that much of your shares that are being should be traded in the open market by the retail investors. In fact, if we look at the example of HDFC, it probably had the highest market capitalization at 100%. That means all the shares were in the retail segment. Now, if we look at who are the various categories of investors and shareholders, now you can have the promoter, and the promoter group is one category. Under promoter group, you can have the Indian promoters, like your Indian individuals, the Hindu undivided family, the central and state government in the as promoters, or the Indian corporate bodies as promoters, or financial institution and banks as promoters. You can also have foreign promoters. Now, like foreign individuals, foreign corporate bodies, and qualified foreign investors. In the non-promoter segment, again you have various institutions like mutual funds, the venture capital funds, the insurance companies, the FIIs, the foreign institutional investors, the qualified foreign institutional investors, the central and state government acting as non-promoters, of course, and the non-institutional investors. So they can be the like the individuals, they can be the non-promoter shareholders. Apart from that, you also have the custodian. Those who, these custodians, they are holding the shares in if you don't want to have it in your name, you can appoint custodian who will be holding the share on your behalf. So that is also a category of investors in the Indian companies. Now we have to we ensure how does the free float increase, because free float is actively, I mean, promoted by the SEBI as well as the stock exchanges. Now the free float, how do you increase the free float? To increase the free float, your non-promoter shareholding has to be maximized. So if that is there, then your free float will increase. Now, of course, if we when you know that the free float is increasing, that means your investor base is becoming more and more diverse. Now, if we look at the concept of this, what is this investor relation and why is it needed? Now, to have a feel of what is a investor relation, now if you look at, let us say in the corporate form of the business, of the stakeholders put their resources based on the trust, the reputation, and the risk reward profile of the investor. Now, who could be the stakeholders? There is a difference between a shareholder and the stakeholders. The shareholders are a major stakeholder in a company. They're just one of the stakeholders, but there could be several other stakeholders. For example, the government could be a stakeholder, the the lenders of your company, they can be stakeholders, the suppliers of your company or creditors of your company, they are your stakeholders, the employees of your organization are stakeholders, the customers are a big stakeholders in your company. So there can be several stakeholders. Now the point is, the who are sharing the resources with us. Now the we know shareholders are the investors, and of course they are sharing their financial resources with us because they trust the company. But how do we know about other stakeholders? For example, the employees. What resources are they sharing with the company? They are giving their time to the organization. When an employee sticks to an organization for, let us say, 5, 10, 15 years, why does he do so? He is doing so because he understands that the company is doing a good job and probably will be in business for a long period of time. So that is why he is investing his time in the company. Similarly, a supplier or a creditor, he knows that the company will honor the commitment, and because the company is in the business to earn some profit and be there to grow, so they will be I mean, inclined to share their credit with you. So the various stakeholders, everyone puts their resources because they have trust on the company, because their company has a reputation, and because the risk reward profile that they're getting from this company are commensurate with their requirement. So when I'm talking about a risk reward profile, what do I mean? The meaning is, now you see, we often hear the statement that risk is directly proportional to return. Now that means if you take high risk, you will get high return. If you take low risk, you will get low return. Now every company's investment will come with a certain degree of risk and a certain degree of return. Now this return risk composure of a particular company, that means if I invest in X company's share, what is the risk I'm undertaking and what is the return I'm getting out of that, that is called the risk reward profile of the particular company. Now you see, in order to create and you have to and consequently enhance this trust and the reputation, you have to provide information to the various stakeholders. Okay, they and how do you do that, and why do you need to do that? Now you see the risk return profile, sending a message regarding this risk return profile is not something that is visible to open eyes, or the reputation is not something that can be visible to open eyes. So you have to communicate this trust, I mean, communicate this reputation and this risk return profile through the investor relations, and that is how you will build the trust of the investors who will invest their resources in your company. Now, in a survey, it was seen that 68% of the chief finance officers and the executive officers, 51% of the CEOs, they all actively participate in these investor relationship activities. And 40% companies have outsourced their investor relations activities mainly for the back end closing activity, which is not at all advisable, because it is to be incorporated in the company like any strategic decision making is taken care of. Now the perception studies were mainly outsourced, and annual report preparation involved both in-house and outsourced effort. So now if you look at the significance of your, what are the goals that the investor relation is trying to achieve. The investor relation has three major goals. That is, one, they have to enhance the engagement of the shareholders. So what is the meaning of this enhancing the engagement of shareholders? The point is, suppose if I have purchased the shares in a particular company, then my continuity with that investment is called the engagement. Or for that matter, if the company comes up with a new issue, my willingness to buy further shares in the company is called as the engagement. Now, if you are not able to engage the shareholders properly, what will happen? The shareholder loses trust in the investment and he sells off the share. Now, like that particular investor, this might be a effect which will be carried on to several investors, and when many investors lose their trust, they will sell the shares of the company and would like to buy further shares of the company. Then the price of the share will nosedive, and so there will be a crash in the stock market I mean the market price of your company share. So when we talk about the engagement of the shareholder, it is basically meaning that he continues to hold the investment, and he wants to buy in case of the further issue. Now, why would someone like to do that? Because you have shown that the risk return profile you are offering to the investor is quite commensurate with what he is desiring for himself. That you can do through proper investor relations. Now you have to improve the financial disclosure and overall credibility. Now when we talk about the financial disclosure, now see, every company comes up with an annual report. Every At the end of the year, financial year, they come up with an annual report. The annual report talks about a lot of activities of the company, and what the company is aiming to do in the next immediate future. That also is there. The director's message, the various financials of the company, they all are communicated to the investors through the annual report. Now, the more transparent your annual report is, the more the information you are conveying through this annual report, that will improve your credibility in the market. So the disclosure, the financial related disclosures, there should be transparency in them, and that can be done through the investor relations. Now, you also enable better compliance and corporate governance through this investor relations department. Now, there are several challenges for this particular activity in the corporation. The challenges could be like the successful articulation of the intrinsic value of the equity and the potential equity value is could be sometimes a difficulty. Now the point is, now there are two things that we need to understand here. What is this intrinsic value, and what is this potential value? Now, the intrinsic value is called as the true value of a equity. Now, true value, it is basically the discounted cash flows discounted and expected cash flows, whatever cash flows you're expecting from this particular share, if you discount them at a proper discount rate, the value that you get is called the intrinsic value. Intrinsic value is called as the true value of the company. Now, when we are talking about intrinsic value, we are looking at the scenario that is prevailing today. Now, the point is, the when the company grows, suppose we have factored in while computing the intrinsic value, we have factored in growth rate that is quite normal, because we see this is how the company is going to grow. But the company can also experience certain phases of very high growth, which was not captured into this intrinsic value. So that is called the potential value. So the company's potential to grow is sometimes not factored into the intrinsic value. So when we factor in what potential the company has to grow, then that is called the potential equity value. For example, sometimes the equity value, the intrinsic value could be, let us say, 100, whereas it could be selling in the marketplace at the price of 60 only, but the intrinsic value is 100, and the potential value could be, let us say, around 180. That means the share is currently selling at a very high discount in the marketplace, because it is not even factoring in the intrinsic value, and potential value is what the company is capable of achieving. So these two things cannot be successfully articulated through this, difficult to be articulated through this investor relation. So that is a major challenge for the investor relations. Now, because this investor relation function, it is not till date, it is not yet perceived as a hardcore management function. Like, what are the other functions that we consider hardcore, like financial management, like the operations management, or the human resource management? We all consider the marketing part, we all consider them as the hardcore management functions. But till date, we have not been considering this investor relations as a hardcore management function. So that is why the IR has yet not been positioned as a strategic decision making or a strategic function of the company. The sooner the companies realize the importance of investor relation, the better it is for the overall financial health of the company. Now, the other challenge of the investor relation is to communicate the guidance or the expectation of the top level management to the managers in the downline. So that is what the top management expects out of these grassroots level of staff, or the grassroots level of managers. That sometimes that has also the investor relation has a role of communicating that as well, but sometimes that is not done. So there is a huge gap between the expectation and what the delivery of a particular thing. So these are the challenges for an investor relation. Now, if you look at the key considerations that are there for the implementation of this investor relation function, we can talk about the management of the company should ensure that when we are talking about investor relation as a function, as a management function, you have to first ensure that there has to be, you have to first secure the commitment from the topmost level, or the secure your board commitment. Now, the why it is a good idea to seek the board commitment is that now this will open up a long term and a two-way communication between the various levels of management and the stakeholders, be it domestic or be it foreign entity. They may be long-term stakeholders or maybe short-term stakeholders. Now, the different categories of stakeholders will have need for different kinds of information. So the IR function should, sharing of information as far as the finances are concerned, the board might not agree to share some of the crucial bits of information with the stakeholders. So when we're talking about investor relations, we are basically talking about transparency. Now, transparency will come only when we communicate things about the company to the investors. Now, if the board is not, the top management, if they are not, willing to share that information, then investor relation will not be successful. So to implement this investor relation function, the first thing that you need to do is secure the board commitment first. Now then the from form the investor relation team, like form a team of who will be dealing with what, and assign them responsibility. See, under under normal circumstances, the CEO and the CFO are the ones who are entrusted with this responsibility of investor relation. But when the company ventures into new business line or development of new market, it is always better to associate the key personnel of this venture capital into this IR team. Now the even the external advisors, the role is also very important while talking about the investor relations team, because they understand the scenario outside the company. Then you have to identify the current and future investors. Now the investment climate is a dynamic one, and there is always probability of investor shifting from one company to the other company, because they are always looking for better returns and lower risk. Now so it is your job to always analyze the bond register as well as the equity register, to have a look at the who are your current investors, okay, and the composers, like how many of them are retail investors, how many of them are institutional investors. Now it is always easy, suppose you are not transparent in your dealing, it is always the retail investors who face the heat of the opaqueness of the company's policy. So you have to actually identify who are the current and the future investors. Then you determine the investment proposition. Now the IR team that we have put in place, they should clearly articulate why should an investor invest in their company. Okay, this will require the team to have a thorough analysis of the various financial positions and operations of the company, and analysis will basically translate into the what will be the ability of the company in future, and what kind of capital growth or income that the company can provide to the investors, that can be clearly specified if you do engage in the research of these things. Then you select the appropriate mix of communication tool, like how are you going to communicate. Now for example, if you are listed in the stock market, then there is a compulsory list of disclosure that is there, so you have to disclose there. Now apart from that, so what are the other voluntary ways of disclosure that you want to undertake? Do you want to have a media coverage of your various information disclosed? Do you want to do it through the social media? So what should be your communication tool mix? That also has to be decided. And then you set your reporting calendar. Now the reporting calendar could be annual, could be semi-annual, or could be quarterly. Now with increased use of technology, many years, let us say 20 25 years back, the reporting system used to be annual. Now but with increased use of technology and dissemination of information, the quarterly has become a norm now. And in fact, the investors or the stakeholders, they are actually wanting real time update about the company's i mean financial disclosure. So you decide what should be your the reporting calendar, but it should not be more than a quarter. At least you have to report everything on a quarterly basis. If you can still shorten your reporting duration, that is much better, but more than a quarter is not now acceptable by the stakeholders. So then once you have gone through these the key considerations in the investor relation function, then we talk about this investor protection. Now the point is the the company form of this, so we have understood that the investors, they require that the company should disclose some information to them, for them to be able to form an idea regarding the company's future prospect, so that they can decide on their future course of action. So this process, the process through which the company communicates with the to the investor regarding this future prospect, is the investor relation function. Now, this investor relation function is very closely associated with something called the investor protection. Now, there are various, avenues available for, and there are in the Indian market, for the investor protection, there are several legislations or several agencies which are engaged in this investor protection. To look at a few, you have the Companies Act, that is that can check whether a company is registered on legally under this Companies Act. So the registrar of the companies, he will make sure that the company that is formed is genuine, and it has been formed with the purpose of doing business and not for any other spurious reasons. Now, the investor interests are also being protected by SEBI, because SEBI undertakes activities such as investor awareness campaign and investor protection campaign through various academic works. Now, the SEBI also has laid down some listing requirement for the companies now who seek to raise money from the small investors to the public. Now, SEBI has mandated that if you are approaching the public for raising capital, then you have to fulfill certain criteria, and you have to list yourself in a stock market. Listing yourself in a stock market means that your shares will be publicly available for trading in the online segment for the retail investors. And for listing, there are certain mandatory disclosures that are there. So you have to disclose. So many companies have delisted themselves from the share market because they don't want to divulge much information about themselves. And because when you are divulging information, it is not the only the investor who is looking at your information. Even your competitors are looking at that information. So many companies don't want to divulge information to the competitors, so they have delisted. So the SEBI requires that if you want public money, then you have to list, and you have to list in a stock market. You have to go for several points of disclosure. Now, so you have to disclose about your operations, you have to disclose about your shareholding pattern, you have to disclose about your strategies. So a lot of things you have to disclose when you, and through this disclosure, the shareholder will come to know about the functioning of a company, and then he can make up his mind whether he will invest or not. Then the Chartered Accountant, Institute of Chartered Accountant of India, it has laid down the necessary accounting standards based on which the companies will prepare their income statement and the balance sheet. And at the end of the year, it has to be audited by the recognized chartered accountants. So when the chartered accountants audit the statements, they point out the several wrongdoings in the company, and they point the same thing to the other legislators. So basically, the chartered accountants ensure that the company does not engage in any unlawful activities, financial transactions. Now, when we talk about information, we know today the information is power. So, who demands information about a company? Now, you see, regarding a company, several people might require several kinds of information. Now, we can have who are the parties who will demand information from a company. It could be government, regulator, or a policymaker. It could be, now why would the government want information from the company? Now, government seeks financial information to check basically if you are paying taxes, correct taxes, and at the right time or not. It also wants to check if you are violating any licenses or any export policy. If you are doing that, the regulator and the policymaker would like to see that. Then the suppliers want the information. Suppliers and lenders, they want the information because they have to ensure that the company will stay in the business for sufficiently long period of time so that they can recover their money, and so it is they will find it worthwhile for them to do business, because if you are here today and gone tomorrow, then and the supplier has supplied to you, then he's nowhere, he cannot recover the money. So he needs to know whether your business is sustainable or not. Similarly, the lenders will use the information to verify how creditable your company is, what is the credit worthiness of your company is, because they will be lending you money. They need to know whether your company can repay the capital and repay and give the interest or not. Now the managers also require information, because now the managers, apart from this lender and suppliers, the manager will require tidbit of information for planning and control purposes. Now of course, the information of the manager is both internal as well as the external. Now and it is quite confidential as well, the information that the manager wants. Now the employees, of course, they want the information about a company, because they need to decide on their continuity in a company. They need to be sure that the company will pay them at a correct time. Now the customers, or the consumers, end users, they would be interested in knowing whether the company would exist in the future to provide them the service. Maybe they product a purchase, sorry, they purchase a product, but are they sure to know whether that is serviceable or not? Because if you don't get service for a product, that is of no use. So they need to ensure that the company will be available for providing service. Now, the analyst, are a very important segment of people who demand information from the public, because they want to publish reports on the performance of the company, and they want to rate the company based on the debt repayment or the pay repayment of the loan. The analyst will continuously track the company for information. It will analyze the company accordingly, and it will inform the public to whether to buy the investment, the shares of a company, or to say, if they have already bought, they need to hold it or they need to sell it. This kind of advices will be given, and this advice he will charge some amount of money to give out this kind of advice. So the shareholders, and the investors, they demand information because they want to safeguard their interest in the particular farm. Now because you need to control, the shareholders need to control the and guide the managerial activities of the board of directors, so they need the information. Now the objective of the existing shareholder is that that the firm should act in a way so that the value of the shareholders is maximized. Now, so the point is, there could be a new group of in people who are willing to invest in the, so you can have the prospective investors, and you have the existing investors. So the requirement of existing investors is to know that what should be the future of the farm, and the whereas when we're talking about prospective investors, they need to know how the farm is currently doing and what should be the future of the farm. Okay, so the shareholders and the investors, that is why they require different kinds of information. Now the point is, you see, there are various demands of the investors on the shareholders, and these demands can be categorized into three different categories. That what kind of information should be there. That is, one is the transparency and disclosure. The basically the demand from the investors, basically, and the shareholders. There's transparency and disclosure, corporate governance, good corporate governance, and investor service. They're the three things that the investors desire from the investor relations of the company. Now, we'll talk about each of them one by one. So let us say disclosure of information. Now the and transparency and the disclosure. Now the companies we have seen that the companies typically they don't come up with announcements every day. That means they don't make the information available on a day-to-day basis, because there are strategic decisions. Like for example, if you are planning to give a dividend, you will not disclose that before the payment of dividend. So you there are intervals in which the company makes the information available regarding the various strategic decisions also. Now and because there is also huge cost involved in the collection and dissemination of such information to the user. So in what will you disseminate? So you will disseminate information, so you need to collect the information as well, and collection of the appropriate information is quite costly. So then once you have collected the appropriate information, then you will disseminate to the end users. Now, the companies disclose a summary information periodically. For example, the quarterly earnings announcements, the annual reports at the end of the year. Companies does that. But the corporate disclosure of information, it is basically how much the company will disclose, how frequently it will disclose, it should disclose. These are all basically driven by various forces. Now, which are the forces that drive this kind of information sharing? The market forces, the various costs that are associated with the corporate disclosures, and the regulatory forces. Just we'll have a brief discussion regarding what are these market forces. Now, if you look at this disclosure of information and the model, now you see these are the decisions of the firm and the decisions by the non-farm information sources. For example, the brokerage houses, the industry, and the trade associations. There is an interaction between these two. The decision of the firm affect this, and the decision of this sector non-farm information also affects the decision. Now the decision by the firm to share information is affected by the regulatory sources as well as the market sources. Okay, so and that will decide what kind of information will be available to the external parties of the organization. So we'll first look at the market forces. Now when we talk about market forces, we will basically look at the three forces that act in the market: the capital market forces, the labor market forces, and the corporate control market forces. Now the corporate firms, we talk about the capital market forces. The corporate firms, they compete, they are always competing with each other in the capital market for resources. Now the point is, if one company is trying to tap the equity source, suppose at a time 5 companies come out with equity issue, so it is the same investor pool that the companies are approaching for equity issue. So naturally here the companies are competing among themselves for the various capital market resources. So they may come up with various instruments to meet the requirement of the investors. They may use different instruments, like one might use equity, the other might use debt, the other might use a zero coupon bond, like that. So, but basically, trying to tap the same pool of investors here. Now, the point is, now this kind of the force, it will exert the firms. Now when you're competing for the same pool, now there is a pressure on you to provide information relating to the instrument that you are going to offer, the various terms of your instrument. For example, are you coming up with a 7-year maturity semi-annual coupon bond, or are you coming up with a convertible bond, or are you coming up with a class B shares? So like that. So you have to term of the instrument you have to discuss, the distribution of the expected return. So depending on the instrument, what should be the expected return from the instrument, and more importantly, for the project for which you are raising the capital, that also needs to be disclosed to the company, so to the public. So the point is, whichever company does this in an appropriate way, the investors will find that company trustworthy and will put their investment in that particular company. Now again, you have in the labor market, you have competition there also in the labor market. Now the the pressure here is to maintain your reputation in the job market. Okay, so the labor market forces will exert pressure on you to basically disclose information which improve the prospects of the manager as well as the reputation. So basically, if no manager would like to come up with a reputation that he worked for an organization which did not do good job, or that will reduce his also marketability. So the pressure here is to maintain the marketability or the creditworthiness of the company and to maintain the reputation of the company. Similarly, now you can have the corporate control market, wherein now you can have the supply of information here is affected by the two factors. Now, the first is by prompting the existing management of firms to disclose information to public, and secondly, so the threat of action of corporate predators and raiders who continuously explore the opportunity of takeovers. Now, the point is, the investors perceive, if it is investors perceive that a company is not being run efficiently, and the management is not appropriately utilizing the resources of the company, so there could be chance of a hostile takeover, and the investors rather would want that the company's management should change and some other management should come into picture. We have seen many proxy battles for the control of a company in the past. Now, the point is, when we're talking about efficiently managing our organization, now the existing management will have to disclose information to public to gain their trust, and if the public is convinced that the management is doing fairly good job, then there might not be any chance of a takeover threat. But if the public is not convinced regarding your efficiency, then there could be chances of a takeover. So you need to disclose. Then you talk about the various costs that are there to in disclosure. Now you can talk about the collection and processing cost, which will be borne by basically the suppliers and users of financial information. Now it is costly process to collect and the process the various information that needs to be disclosed. Then you can have the litigation cost. Now the litigation cost is basically the when you face a legal dispute, the redressal of the legal dispute or the corrective information, that will involve a cost which is called the litigation cost. You can have the political cost that will arise in situation where the perception of the government and the policies of government that are influenced by the disclosure of corporate information. That could be, there could be political cost. There could be competitive disadvantage cost when the firm chooses to reveal a portion of a proprietary information have. Actually, maybe it chooses or maybe it is forced to divulge some of the proprietary information. It could lead to competitive disadvantage for the company. Now, typically, the firm they always choose to keep the strategic information like the R&D information, the new product development, the advertisement expenditure, the breakdown of major customer, and the forecast of the margins. So these companies, they don't want to disclose this kind of information. Now, because maybe you want to raise new capital but you are not able to get it, so then in that case you might be forced to disclose these things, so that could be the cost of your disclosure, because the competitors will use this information to their advantage. Now, there could be certain other additional constraint, like the when the managers disclose certain type of information, it imposes constraint on their behavior and it may lead to the conflict between their efficiency and reputation. For example, the earnings forecast and the disclosure to the public put a manager on the pressure on the manager to implement the policies. that result. So for example, you had put out in the public domain that the earnings of the company is going to be such and such, and you see that you are not able to meet your forecast, so there will be pressure on the manager to stick to that particular forecast, otherwise there could be negative news about the company in the market. Then there could be several regulatory forces. Now what are we doing? We are talking about here the various market forces we have discussed, the various cost we have discussed. Now we are talking about the regulatory forces. Now in the regulatory forces, you see there are number of regulating agencies that govern the functioning of the corporate and the disclosure of information. And if we talk about the various levels, there could be four distinct identifiable levels that we can talk about. The first level is the government and the regulatory bodies. The first level is the executive, the legislative, and the judicial branches of the government. Now, you see, the legislative will make laws which are enforced by the executive. Now, the judiciary will exert influence on the disclosure of the parties. So, the first level is the executive, legislative, and the judicial branches of the government. The second level, level two, is the regulatory bodies such as the SAB, the Company Law Board, and the Department of Company Affairs under the Ministry of Finance. Now, these agencies are often delegated with the authority of overseeing and to the adherence of the rules and regulations. Whether the company is adhering to the rules and regulations, they are also done by this level 2. Then the level 3 talks about the private sector regulatory bodies such as the Accounting Standard Board, the Institute of Chartered Accountants of India, and the stock exchanges. For example, the stock exchange will ensure that the companies come up with a disclosure before they're eligible to be listed in the the stock market. Or for example, the Institute of Chartered Accountants of India, they will enforce that the company sticks to a particular, let us say, a depreciation strategy. The Accounting Standard Board will probably talk about, let us say, what kind of accounting principles to be used in the preparation of the various financial statements. Now, the level 4 it does not have a direct impact on the disclosure, but these are lobbying groups. Basically, the level 4 are basically the lobbying groups that attempt to influence the decisions that are made by the parties in the above 3 levels. Now, who are these lobbying levels? There's basically professional bodies. It might include the industrial and the trade associations. It might include the investors association and other interest group. To name one such, if you talk about the NASCOM is one of these kind of a group. The ASSOCHAM is probably one of these kind of a group. So these are lobbying groups that influence the above 3 categories of the regulators. Now, as we talked about why the investors want the proper disclosure of this thing, information, is to have good corporate governance. Now, when we talk about this corporate governance, this has a very important role in building a good relationship between the company and the investor. Now, because the companies they are able to keep their investor well informed about the way the company is doing business, and that is done in a very very transparent manner. So when the company does that, then it builds the investor confidence and wins the trust of the investor. So that is why it is absolutely needed for a company, for the investor relations, to have a look at the corporate governance system that is in practice. Now we see when we know that a well governed company that is governed well, it has specific characteristics of good governance. Now, for example, you will have the directors which are recruited from outside. They have no management ties. The directors, for example, you don't have the promoter's son, the promoter's daughter, the promoter's relative. They are not on the board of directors, but the board of directors are professional people hired from outside and having very specific expertise. So that is one sign of a good governed, good governance. Now the you are holding formal evaluation of the director. Now if you have hired a director, you are going for proper performance appraisal of a director. It seldom happens in case of Indian companies, that because most of the times these the directors are basically drawn from family, but and so you don't have formal evaluation of these directors. But a company which does that, that is a sign of a good governance. You are responsive to investors request for information on the various governance issues. So if you are prompt to give information on these various issues of governance, then that's a sign of a company that is well governed. Now you see the directors, they hold significant stockholding, because the directors are a part of the management, so they have a big chunk of shares with themselves, and get a large portion of their salary also through these employee stock options. Now, it is of utmost importance, that is why, to see that the directors are performing professionally and which is in the best interest of the company. Now the good corporate governance also helps the company to better evaluate the investment decisions. Now, suppose there is transparency in disclosure and professionalism in the conduct of the various disciplines, then you can appropriately evaluate a good investment decision. You are not swayed away by who is the supplier or who the project belongs to. So you can be very specific in your evaluating the investment decisions. There could be appropriate resolution of the agency problem, and the agency cost will be minimized. Yeah, the problem of agency we discussed in the last class, and the techniques that we undertake to resolve this conflict are called as the agency cost. That can be done. Now you can retain your existing investors, and you can get new investors into your company, so that that will ensure that you are raising capital. I mean, the company which is well governed can raise capital with much ease as compared to a company that is not well governed. Now, the good governance will also ensure that the suppliers also have trust. Suppliers and lenders will also have trust on the company, because your disclosure norms are appropriate. Like when you are talking about a prediction for future and the cash flow that is expected, the suppliers and lenders are more interested with the immediate cash flow. So if there is absolute transparency in what will be the cash flow in the future, even the suppliers goodwill and the lenders goodwill, creditworthiness will also be maintained, and they will not be hesitant to give lend to your company, or to supply to your company, and extend the facility of trade credit to your company. So a good corporate governance will ensure that all the stakeholders, they are aware about the various aspects of the company. Even the bad aspects of the company, they are also, not bad actually, the areas which need improvement of a company, that also is in the know of the various stakeholders. So that builds trust among the stakeholders. Lastly, we talk about this investor service. Now the companies, they gain substantial advantage by this the transparent policies and the disclosure practices. So the investor relation, the discussion for today is about the investor relation. So the companies which can do proper investor relation, they will get this advantage of the investor trust building. Now, so to sustain this good relationship that you have already earned, now you have to provide the right kind of information at the right time and at the right place. You also must attend to the queries of the investors promptly, and give them the better service. The You have to ensure that whatever information you are sharing in the annual report is appropriate and exhaustive. And sometimes you try to ensure that you are providing information which is not mandatorily required but is desired by the investors, and try to ensure that all your information is available in the website itself. So that will ensure that the company's transparency is well maintained and investor relationship is on the right track. So with this we end the discussion on this particular paper. Thank you.